My name is Ted Schuman. As Shauna said, I'm with the DBS Companies, managing partner of DBS Investment Advisors. We are, of course, the endorsed partner, endorsed by Michigan Dental Association for our work in financial planning and investment management for member dentists. I'm going to take just a second and tell you about, the firm, the rest of the firm, I should say, DBS. We are a full-service financial services firm for dentists. Core of the business is accounting and tax. We're Michigan's only member of the Academy of Dental CPAs. We also have a department in the business that brokers dental practices, either representing a buyer or a seller in that transition. We're Michigan's only member of ADS Transitions. We're very proud of that. We also are involved with practice management consulting, and of course, the fiduciary investment management, financial planning, and debt reduction strategies. That's going to end the infomercial. A little bit about myself. I'm the managing partner of the investment advisory line of business, 2006 graduate of CMU's personal financial planning program, Fire Up Chips. I've been a certified financial planning practitioner since 2010. I hold 2 master's degrees from Walsh College, 1 MBA and one master's of finance. I'm also an accredited investment fiduciary. I'm going to take just a minute and give a shout out to 2 of my associate advisors. First one, the most recent addition to the team would be Dr. Jeff Brink. Dr. Brink joined us just this year, actually, in the midst of dental practice shutdown. He and I were able to get together and have a couple of phone meetings and Zoom meetings. Dr. Brink had his own investment advisory firm where he advised dentists for some years for what I would refer to as being a financial coach. He's a full-time practicing dentist and then also did some financial coaching with his clients, and he and I came together a couple of months ago and were able to bring him into DBS Investment Advisors. In fact, I think he's on the Zoom tonight as an attendee. We're thrilled to have Jeff on the team. He's been an outstanding asset. In addition to him, we have Zach Rivard. Zach Rivard is also an associate advisor with us. Zach is currently pursuing his certified financial planning designation, holds a variety of designations in his pursuit of that, and works with a lot of our clients, especially in setting up and managing 401k plans. So Zach's been on the team for about 2 years. Like I said, that ends the infomercial. Let's get into to tonight's topic. So our agenda for today is going to be defining retirement, talking a little bit about ownership exit strategies, a little bit about portfolio construction and portfolio withdrawals, and then we're going to round out by talking a little bit about Social Security. So doesn't that sound like a good time? Before I start with the defining retirement segment of this, I want to invite anybody who has a question along the way to feel free and submit that. Shauna was going to be good enough to moderate the Q&A as we go. I think we're a good sized group to just be able to take questions on the fly tonight. So let's make this as much of a conversation as it is a webinar, because if there's something on your mind, it's probably something someone else has a question about as well. So with that, I'm going to pose what's sort of a rhetorical question in a Zoom meeting. What does retirement mean to you? Retirement means a lot of things to a lot of different people. And one of the things that is sort of become obvious to me over the last 14 years of doing this is that everybody's definition of retirement is a little bit different. Okay, so you could be like the folks in the picture here, where retirement, when you think of retirement, you think of yourself as taking it easy, sitting on the porch on the rocking chair, in your elderly years. Maybe that's what retirement means to you. Okay, could also mean having some time to travel. Could also mean having some time to explore and put some more stamps in the passport, so to speak. Do some of those kinds, take some of those kinds of trips that maybe your full-time job or your full-time practice ownership didn't allow you to do for a lot of years. Now, when you think of retirement, you don't necessarily think of sitting in the rocking chair. You think of getting out and doing things, getting on airplanes, going on hikes, that kind of stuff. Maybe it means being active, or maybe it means spending time with loved ones, family, children, grandchildren, that sort of thing. Might mean staying and maintaining a commitment to your health, which is becoming more and more important these days. If we've learned anything this year, it's not to take our health for granted. But maybe retirement doesn't mean a sedentary lifestyle to you at all. Maybe you think of your retirement as being something that's going to be go, go, go. Maybe retirement for you is going to be philanthropic, or it's going to be charitable in some way. Doing some volunteer work, whether it's formal or informal. Could be volunteering for a cause that's near and dear to your heart. Could be spending some time mentoring other practitioners. Could be time spent in the church. Could be a lot of different things. So if there's one thing that's for sure, it's that the word retirement conjures different images for everybody. There's no necessarily one right or wrong way to do it. One of the things that I think is very interesting, and I've learned over the years working with dentists, is that there's sort of an interesting career cycle of a dentist. When they first get out of dental school, the main goal, the most important thing, the next step is to get out of dental school and get into an associate job, to start being paid to produce dentistry, as opposed to just working in the student clinic like they've been used to the last couple of years. And working as an associate typically goes okay. New graduates able to get out, make a couple dollars, build up their speed, build up their confidence, learn a little bit more than they learned, add on, I should say, to what they learned when they were in dental school, all that kind of stuff. Maybe they do a residency or what have you. And after a couple of years as an associate for someone else, not uncommon for a dentist to think to themselves, you know what? I should buy my own practice. They're an associate, and they look to the owner of the practice that they're associating within, and they think to themselves, I could own my own practice. I'm a good enough dentist now, and I'd really like to make some of the better money, and I'd like to be able to have more autonomy and make more decisions and all that kind of thing. So then they go out and they find a practice that fits them, and they become a practice owner. And one of the things they learn when they become a practice owner is that being a business owner is incredibly rewarding, but with that reward comes a lot of stress, right? Associate dentists don't have to do things like figure out how a PPP loan works. Okay, something that's probably near and dear to a lot of our hearts this year, how that sort of thing goes on. They don't have to worry about dealing with HR issues. Associate dentists don't have a lot of the same headaches that owners do. But once they become an owner, they learn quickly that with that autonomy, with that increase in pay, and with that authority comes with it a lot of stress. So they work the practice that they own for a lot of years, and they're able to make hopefully a nice income over that period of time and pay off their debt and do all that sort of thing. And then they start, after a few years, they start thinking about retirement. They start looking forward to it. And they think to themselves, man, you know what? It's not that I'm ready to necessarily retire from practice, but I am ready to retire from some of the stress that practice ownership sort of brings with it. And they think to themselves, if I could just go back to doing associate level dentistry where I punch in the morning and punch out in the evening and that kind of stuff, it's not the clinical dentistry that's kind of burning me out, so to speak. It's all the other stuff that comes with business ownership. And I call that the dichotomy of ownership. It's always funny to me that some associates envy owners. Meanwhile, some of those owners look back at their associate days and say, hey, you know what? That really wasn't that bad. Maybe the money wasn't as good, but it wasn't nearly as stressful as everything I have to carry right now. And that's just sort of the cycle as I put on the screen right here. You go from being an associate to buying a practice to maybe associating the last couple of years of your career to sort of phase out. Okay, that's definitely one model, and it's one very attractive model for a lot of practitioners out there. So I'm gonna go now and I'm going to pose a question to the group, and I don't know if it'll necessarily lend itself to answering in live time or not, but I'm going to give you a pop quiz. And that pop quiz is, when is the right time to sell the practice? If I were to ask you, if you're a practitioner, if you're an owner practitioner right now, when is the right time to sell your practice? Is it A, when you turn 65, or some other magical number you may hold in your you may hold in your mind? Is it B, when the kids are out of the house, or you're done paying college tuition, or done paying for weddings, or what have you? Is it C, when you've amassed a portfolio of a given number, 1 million, 2 million, 5 million, whatever number you've deemed in your mind as a big enough nest egg to live on? Maybe you've worked with a financial planner, maybe you're a do-it-yourselfer and you've come up with that number somehow, but is it when your portfolio hits a certain point? Is it when you find the right buyer? Is it when you have something else to do? For those of you that are married, is it when your spouse says so? Or G, is it all of the above? And I would suggest that it's G, all of the above, with probably a little bit of a leaning toward D, E, and F being the most important factors. Finding the right buyer, have someone else to do, have something else to do rather, and it works in your family situation. It works between you and your spouse and all that other kind of stuff. You would think that a financial planner like me would think, well, why not when we hit the portfolio goals? And don't get me wrong, that's true. That is important, but at the end of the day, as business owners, there are other considerations. So let's go on and talk a little bit about finding a successor. So let's talk a little bit about finding a successor for the practice. I've talked to some dentists over the course of time, and everybody sort of takes a different view on this. But when it comes to finding a successor, who the buyer for your practice is going to be is far more important than especially some practitioners think. Some dentists think that they won't care who ends up buying their practice, but really at the end of the day, it's one of the most important things on their mind. So some practitioners like to get a little they like to get a little hard-nosed about it, and they say, you know what, I don't care who buys my practice, whoever shows up with the biggest check is going to win. Well, the reality of the situation is that most offers for a dental practice in a fair market are going to be pretty similar to each other, and it's finding the person who's the right fit for your practice, which ends up being the most important thing. I was lucky enough to join my dad in the business years ago. He'd been in the practice transition business for a lot of years when I joined him, and he and I worked together for the last 12 or 14 years. And he had this line, he had this kind of mantra that he used, and that is, putting your dental practice up for sale is almost akin to putting a child up for adoption. And I always thought that was kind of a weird metaphor. I always thought that was kind of a weird comparison. And then about 5 or 6 years ago, I became a business owner. And I got to thinking to myself, okay, my business demands time no matter what. It's the thing that's on my mind all the time. It's the thing that I'm constantly wondering and making sure if I'm doing the right thing to help it grow, if I'm paying enough attention to it. You know, the needs of the business come before most other things in my life. You know, I don't have any kids, but that sounds a lot like probably what having a child is like. And so when you sell your practice, you're almost looking at it through that similar prism. Yeah. Now, one of the things that comes up occasionally when we're talking to practitioners who are looking to transition out is sometimes we have to coach them to throw out some of what we call old world thinking about who their successor is going to be. And that includes items like gender, race, ethnicity, that kind of stuff, those kind of traits that really aren't as relevant to finding a successor as maybe some of the retiring practitioners think. One of my favorite things, and this has happened actually more than a few times over time, is we have typically an older male practitioner, and we have a younger female practitioner that's looking at buying the practice. Maybe the older practitioner is 60, 65 years old, younger female practitioners maybe 30 years old, and he'll say something kind of strange like, do you think this girl or this gal can really come in and do what I've been doing all these years? And it's always fun when the younger female practitioner buys the older male practitioner's practice and has increased production by 25 or 50% in her first year or two of owning that practice because she's a real go-getter. Okay, so you have to throw out some of your ideals like that and forget about finding a clone of yourself. Everybody would love to sell to the version of themselves that's 30 years younger, right? A lot of practitioners remember what it was like when they were first getting into practice. Maybe they didn't buy a practice at all. Maybe they started one in their town or whatever the case may be, and they'll tell you stories about building the practice one patient at a time and having to work Saturdays and all these other things. And they sort of look for that in the buyer or the would-be buyer, and sometimes get disappointed because they don't feel like any of the folks interested in buying their practice are maybe have the work ethic that they thought that they had at the same age. The reality of the situation, by the way, on that is that today's practitioners that are graduating and buying practices today work in a much different practice environment than the previous generation or two did. And I think that happens in every business, but in dentistry especially, there have been a lot of things that have changed the environment of dentistry in Michigan over the last 30, 40, 50 years. And to presuppose that someone who graduated from dental school in the last 10 years is going to work in the same environment that someone who graduated from dental school 40 years ago, it's just foolish. It's not going to happen that way. Most importantly, the successor should focus on philosophy and the genuine concern for patients. That's the reality of the situation. Do they fit the culture of the practice and the approach with patients that you as an owner or a practice, someone looking to sell their practice, a pre-retiree, if you will, do they have the same philosophy and core values and that kind of stuff? That's where most of the fit really takes place. So with that, let's talk about who some of the most likely buyers of a dental practice would be. Well, if you're lucky enough to have a current associate, that's one of the easiest places to find a buyer, and that's actually one of the most ideal situations both the buyer and the seller could be in. For the buyer, it's a very ideal situation because it really shortens the transition curve. You don't have to do as much meeting and greeting. You don't have to ingratiate yourself to the staff the same way. If you're an associate and you've been working in a dental practice the last 2 or 3 years, you're sort of the heir apparent viewed by both the patients as well as the staff. And so you don't necessarily have to work as hard to win either group over. They sort of expected you to become the owner all along. Same thing on the seller side. If you think that you would like to sell to an associate, hopefully you've taken the opportunity over the last year or 2 or 3, however long they've worked for you, to groom them to be the successor you want them to be. One of the things I hear from young dentists over and over and over again is, I want to go to work to someone who's going to provide mentorship. Okay, I hear that a lot. And if you have that opportunity and can be intentional about providing that mentorship, you can not only mentor from a clinical standpoint, but also from a patient interface and culture standpoint. That doesn't mean that a new buyer isn't going to make the practice their own, but in most cases, that's going to be who a retiring dentist is most comfortable selling their practice to. Now, if you don't have an associate, then you may sell your practice to a third party. That's where you list the practice for sale on the MDA classifieds or with a practice brokerage service or something of that nature. You're going to have various buyers submitting inquiries and asking for information and formulating offers and that kind of stuff. And that's where you're going to find the one you think is going to be the best fit for you. Typically, if you're selling to a third party, that's typically going to be what I call a walk-away sale, not necessarily something where you're going to be able to phase out of practice. Oftentimes, you're going to sell to somebody who is looking for, they're looking to be the owner, and you're going to sell the practice to them on Friday, and you're going to move your stuff out over the weekend, and they're going to take over on Monday. Think about it from that perspective. One of the comments that I forgot to make when we were talking about selling to a current associate, on the other hand, is if you sell to your current associate, then that's obviously a practice that needs an associate in it. It's in a practice that maybe more than one dentist can handle. If that's the case, you might be able to do a role reversal and become an associate for the person that you sold the practice to. So you have an associate working for you, they buy the practice, and then you flip and become their associate. That's a great strategy that allows for a nice phase out retirement if that's what works for both sides. Not every buyer and not every seller want that. Not every buyer wants the former doctor to stick around, and not every seller wants to continue to work even on a part-time basis, but there is typically that opportunity if the practice can support it. Now, third likely buyer, and we're seeing more and more of this every year, is to sell the practice to a big group or some type of corporate arrangement or DSO or whatever. Okay, I will confess, I'm an independent business owner, so of course my bias is going to be that dental practices should remain independent businesses. But shame on me if I don't recognize the fact that group dental practices are out there and they are buying up practices extraordinarily aggressively. In fact, my heart goes out to some of the buyers, some of the young buyers of dental practices, because they have to compete with the offers that the big groups in corporate are able to make to doctors that are selling their practice. Selling to group or corporate it's like anything else. It's the right thing for the right person. There are some practitioners out there who are fundamentally opposed to doing it. They don't want to see their business folded into some, they kind of visualize corporate as kind of a nameless, faceless kind of thing, and they don't want their practice to have any part of that. That's not the legacy they want. I'm not suggesting whether that's true or not, but that's kind of their opinion. Others say, you know what, selling to group or corporate might not be so bad. Group or corporate tend to pay higher multiples, but those multiples tend to come with some strings attached. And those strings are going to be things like, we'll give you a good price for your practice, but doctor, you have to give us 1 to 3 years worth of associate work after the sale, and we're going to pay the rest of the purchase price out over that time, and you have to hit production bonuses, and the practice has to grow by a certain percentage year over year, and different things like that. Each one of these groups has sort of a different model, but basically that's kind of what they're looking for. So like I said, it's not necessarily good or bad. It's the right thing for the right person. One of the other models that I hear frequently, but I'm not necessarily that big a fan of, is what I call the partnership to retirement model. And what's happening here is it's a doctor that owns a practice, has an associate. Doctor kind of has retirement on the horizon, but not quite ready to give up yet, and is afraid that they're going to lose the associate because the associate isn't going to stick around very long if they don't get some practice ownership. So doctor thinks to himself, okay, what's the best way to keep this associate around? I know I'm going to make them a partner, and then we're going to be partners for about 5 years. And then once my 5 years are up, I'm going to go into full retirement mode, and that's when I'll sell my current associate, future partner, the other half of the business. On paper, it looks like it works. I'm not a real big fan of this strategy because, in my opinion, it just duplicates costs. So what you end up doing in this scenario is you have to form an entirely another entity for your practice to operate in, because now it's a partnership. You have to put together a partnership agreement. You have to do all that kind of stuff. You have to have the practice valued. You have to get accountants and attorneys and folks like that involved just to do this again in 5 years when you're ready to sell the other half of the business to the new partner. So like I said, kind of duplicates costs and kind of becomes counterproductive that way. If you're looking at doing something like this, I might encourage you instead to either give the associate a raise so they stick around for the years that you want them to be there, if they want to be the success, if you want them to be the successor at all, or maybe approach the associate and say, hey, if you want to buy my practice, I want to make at least this much money for the next 5 years. Could I either stay on as an associate for you, or could we bump up the purchase price a little bit so that I end up netting that many more dollars if that's what it's going to take me to meet my financial goals, or whatever the case may be. You know, reinventing the entities 2 or 3 times, like I said, in my opinion, becomes counterproductive. People have done it, but it's just not the most efficient way to go. So the slide on the screen right now is factors that drive practice value. This is not going to be a surprise to anybody sitting on this Zoom right now. Obviously, the first factor that drives practice value is patients. If patients are basically the inventory of the dental practice, the more of them you have, especially the more active patients you have, the more valuable your dental practice is. Number of active patients, of course, also is a barometer for whether or not you can bring in an associate or something like that who maybe will be your buyer at some point in the future. The practice has to have enough patients to make sure it can support as many doctors as are in the practice. Second thing, probably as important as patients, is profitability and cash flow. We've all read the articles, we've all listened to the podcasts or sat in seminars like this or webinars like this, and someone always comes up with a rule of thumb for how much a practice is worth. A practice should sell for 65% of last year's revenue, 70% of the last 5 years' revenue, 75% of weighted revenue, whatever the case may be. However, that, in my opinion, is a little bit of a flawed approach, because in my opinion, practice profitability is more important than practice revenue. And let me explain what I mean by that. If I have 2 practices that are each doing $1 million in revenue, and practice A only profits $100,000 a year, and practice B profits $450,000 a year, are they both worth the same $650,000, 65% of revenue? I don't think so. The more profitable one is going to sell for a higher price. It's more valuable. It's like any other investment. A dental practice, like any other investment, is going to be priced based on the amount of cash and money, cash or income, I should say, that it generates for the owner. A practice that's more profitable should sell for more money than a practice that's less profitable. Market location is a huge factor. Obviously, practices in desirable markets, Southeast Michigan, Grand Rapids, even up around Traverse City, if you're getting into Northern Michigan, very, very hot markets. They're areas that lots of dentists want to be in. They're also areas that a lot of dentists are already in, so market share becomes a little bit of an issue, but that's a separate point. Location is an important thing, not only as it relates to where the practice is, but with more and more 2 professional families these days, location can be a big variable, because it's not only doctor that needs to have a job in the practice that he or she may own, but doctor's spouse likely has a professional career of their own, and we need to make sure that the practice is situated in such a place where doctor's spouse is also going to be able to pursue their career goals. I'll give you kind of an example on this. There are great practices for sale in Northern Michigan. I'm up in Bay City and even further north of me. There are great practices for sale in rural Northern Michigan, practices with a lot of patients, doing good numbers in revenue, that aren't going to sell for as much as the same practice would sell for in Oakland County, the Detroit suburbs, for example. And people look at these practices and they say, wow, what a great value, what a great buy this would be. But here's the problem. I'm willing to live up here, but my spouse is a patent attorney, for example. And there aren't really any big law firms hiring patent attorneys in rural Northern Michigan. So even though it would be a good practice for somebody to own, sometimes the spouse's career, consideration for the spouse's career, sort of locks them out of it. So just something to kind of to ponder. A little bit further down the list, things like the overall desirability of the practice and equipment and facility. Obviously, young buyers are typically enamored with practices that are highly technologically advanced and developed, have digital everything, CBCT, that kind of stuff. At the end of the day, that can be a hook for some buyers, but a well-advised buyer will be able to evaluate the opportunity of a practice and implement their own technology if it's otherwise the right deal. So just something to think about. A finance guy couldn't talk about practice transitions without, of course, referencing how the sale of a dental practice is treated from a tax standpoint. I'm not going to spend a lot of time on this. Suffice it to say, when a practice is sold, the purchase price has to be divvied up among different accounting asset classes. Think of it from that perspective. So things like equipment are pretty self-explanatory. That's all the dental equipment, the chairs, radiographs, et cetera, et cetera. Things like goodwill are basically the reputation of the practice. Believe it or not, the goodwill is what you're buying. You can go, you can replace chairs or go online and buy new ones or buy replacement ones or whatever. But goodwill is really the thing that's unique to the practice. That's the opportunity that the new buyer would be buying. When a practice is bought or sold, depending on what side of the transaction you're on, you either recognize income differently or deduct the expense differently based on what part of the purchase price is attributable to which sale item. So how much of the total purchase price of the practice is attributable to goodwill, covenant not to compete if one exists, equipment, and then inventory and supplies. Again, what's good for the seller is bad for the buyer and vice versa. I do want to take this opportunity to remind anybody in the pre-retiree phase, if you're thinking about selling your practice, you probably have a number in mind. That number is probably pretty close to what the thing is actually going to sell for. But don't forget, what you sell the practice for isn't what you walk away with. Obviously, there's taxes like those reflected on the screen, legal fees, brokerage commission, you have to pay your accountant to shut down your corporation, all that fun stuff. Typically, what your walkaway number is might not be as high as you're thinking. So make sure that you have an awareness of that. In fact, if you're serious about selling your practice, I would encourage you to contact your CPA, run a couple scenarios so you can kind of know what to budget and plan for financially speaking. One of the things that I would encourage someone selling their practice to do is to keep the proceeds of the practice sale in cash. That way they have a little bit of emergency fund safety net if they're going to depend on their investment portfolio and they find themselves in a down market. Having that cash as dry powder can be a very helpful thing. One of the great strategies to use if you are planning on continuing to work after the sale of the practice is to see if the new buyer would be agreeable to paying you as a subcontractor. If you can keep your entity open, have your associate income paid to your business entity, and continue to deduct some of the expenses you're probably used to deducting through your practice over the years. Maybe things like travel, meals, cell phone, things of that sort. So some of those perk expenses that you've probably been paying through the practice for a long time due to the tax efficiency. Also works out very well because you can keep your retirement plan open. And if you net enough from the sale of the practice, use some of those dollars to fund the retirement plan, which helps offset the tax impact of the sale of the practice. This works pretty well if you're going to continue to associate. This has worked very well if the transition is friendly in nature. If you're selling to a child or another family member, somebody who's willing to be flexible with you, that kind of stuff. So moving forward a little bit, that's a little bit about practice transitions. I'm going to kind of switch gears a little bit toward the financial side. And for anybody that's wondering, yes, I am the kind of guy that would quote himself in his own Zoom webinar. I have a saying that retiring isn't a financial decision, it's an emotional decision with financial consequences. So we're going to switch gears and talk a little bit about the financial consequences at this point in time. I'll talk a little bit about portfolio construction for a retiree or a pre-retiree. Just a couple of comments on where the market is right now. We are all acutely aware that COVID-19, as well as the 2020 presidential election, has dominated headlines for the year of 2020. It's been an interesting year, both in capital markets and just in general. Some of you might remember that markets sold off as the first cases of COVID hit the US, and the bottom kind of fell out of the stock market in the first quarter, hitting its lowest point on March 24th, 2020. So that's as bad as it got, was March 24th of this year. Since then, markets have rebounded, and they've rebounded exceptionally well. Year to date, even considering the market meltdown in March, the S&P 500, the stock market in America, is up about 16% year to date. The Barclays aggregate, the bonds are actually up about 7%, which is a pretty nice return in both asset classes. Now that we've got the election behind us, and obviously COVID is still a big question mark in terms of what the short and long-term effects are going to be, although the market did get a little reassurance in the last week or two as Pfizer and Moderna have come out with vaccines and that sort of thing. But the big question on everybody's mind is, now that the election behind us, is there going to be a stimulus 2.0? You may remember earlier this year, the CARES Act came out, which is a $13 trillion stimulus package, which really helped prop up markets, or really helped bring them out of the March lows, I should say. And that's where we got things like $600 a week unemployment benefits, $1,200 stimulus checks, PPP loans, all that fun stuff. So the next question is going to be, is that enough? And do we need to do a second round of that? And if so, what is that second round of stimulus going to look and feel like? Brace for markets to really be paying close attention to whether or not that materializes. One of my favorite pieces to go over with investors, this is a piece published by JP Morgan, shows where different asset classes, where different types of investments have returned, not only on a year-to-date basis, if you look under the YTD column, but also going back all the way to 2005. We're not going to spend a lot of time on this. The front runner year-to-date, as I just mentioned, is large U.S. stocks. The best thing to be invested in this year, and last year for that matter, has been large U.S. stocks. The worst thing to be invested in, if you look down toward the bottom of the column, is commodities. And we think to ourselves, okay, large US stocks, I get it. We have all the big tech companies that are a little bit more insulated from COVID. Amazon's doing great since we can't do anything but sit at home and buy stuff on the internet anyway. It makes sense that large US stocks are doing okay, but why are commodities way down at the bottom of the barrel? Well, commodities are really a proxy for industrial inputs. Think about things like steel, copper, oil, all the stuff that's used when there's a lot of global growth happening, and those things are needed for, like I said, for construction and manufacturing inputs and that kind of stuff. Well, with the onset of COVID, global growth came to a screeching halt, leaving that as being the worst performing investment for the year, because there's a supply glut. There's a bunch of oil, a bunch of steel, a bunch of copper, a bunch of all that stuff in the market that nobody needs, so nobody's buying it, and the price is suffering accordingly. Some investors are concerned that after seeing double-digit returns in the U.S. stock market, 16.5% this year, 31.5% last year, as represented by the green blocks on the handout, that the market in the U.S. might be a little bit overvalued. With that in mind, some investors are thinking that there would actually be better buying opportunities overseas. The handout on the screen basically illustrates that point, that on a price to earnings basis, in other words, if you look at how much a share of stock costs relative to the profit of the underlying company, it's actually overseas markets that are a better buying opportunity right now than US domestic markets would be, which stands to reason. The market hit new highs back in 2019 and isn't too far off that today. So of course, that's going to look a little expensive on a historical basis. So what do we do with this information? Well, this is what we use to construct a retirement portfolio. For someone in the retirement phase or pre-retirement phase, or what I call distribution or decumulation phase, their investment strategy has to be a little bit different than someone who's in the accumulation phase. Their investment strategy has to be different than the person who's putting money in their 401k every 2 weeks. Think of it from that perspective. If you're constructing a distribution portfolio, obviously it's going to have a conservative orientation. You're not going to abandon the riskier investments like stocks, for example, but you're probably going to recalibrate what stocks are in your portfolio. You're also going to make sure you have enough cash in your portfolio to support your withdrawal needs for at least the next 1 to 3 years. That would be my recommendation. And probably a higher allocation to bonds, to fixed income. That should help mute a little bit of volatility in the portfolio. And if interest rates ever go back up, which we don't think they will for at least another 2 or 3 years, you can hopefully get a little bit of income from that as well. So with interest rates being so low, the only place investors can go for income is dividend paying stocks. Like I said, that's why you reevaluate what stocks you're holding in your portfolio. The stocks are needed for growth. Not necessarily the same way they were needed in the accumulation phase, but you still need a little growth in your portfolio, because when you're in the distribution phase, when you're in your retirement years, you're going to be pulling money out of that portfolio, and you need to replenish some of what you've drawn out to live on. This is a sample of what I call a distribution allocation on the screen. On the left side is kind of the baseline allocation. Please don't everybody go to their Schwab account right now and try to replicate this. This is just an example. It's just a starting point. If you look to the right, you'll see some of the tactical adjustments that would maybe need to be made to a portfolio of this nature. What you see under the base allocation heading is you see 50% of this portfolio invested in large and mid-cap US stocks. We want that because that's where the dividend payers are. And we want that because we still need a little bit of growth in the portfolio. You look at the bottom 2 lines, the bottom 40% of this portfolio, 35 plus 5, that's the safer stuff in the portfolio, the fixed income, the bonds, the cash, the stable value, the things that'll sort of help keep your portfolio balanced in times of volatility. Think of it from that perspective. Right now, growth is a secondary objective. You're looking for income and you're looking for sustainability. What you're doing in this portfolio is you're looking for a portfolio that you can draw money off of on a month-to-month basis, regardless, or annual basis, or however you take it, is regardless of what the market conditions are. Okay. Rule of thumb: you can typically take 4 to 5%. Out of a portfolio annually, increase for inflation. You can typically do this for 30 years if you're getting 6% on your portfolio, and that withdrawal rate of 4 to 5% will sustain an investor through any sequence of historical returns. In other words, there has never been a 30-year period where an investor was not able to do that, at least in the US stock market. Not uncommon that an investor will build up their portfolio using different types of accounts. A lot of us use things like simple IRAs, 401ks, SEPs, that kind of stuff, investment vehicles that give us a tax deduction when we put the money in. Other investors aren't necessarily as excited about doing that. They like investing in Roth or in an after-tax individual account that doesn't have necessarily the same tax deduction when you put the money in. So what I'm going to share with you right now is kind of what I call the tale of 2 investors. The example I'm going to show you is one investor who's built up $1 million in their portfolio, and they've done it all in a pre-tax way. So let's say they've done it all in their 401k or traditional IRA or simple, something where they got a deduction for every dollar they put in the account, and all the investment growth has been tax-free. Okay. This person has a colleague, and that colleague has also built up $1 million in their portfolio, but they only did 1/3 of it in their traditional IRA, simple or 401k. The other 2/3 were split between Roth and an individual taxable account. So they didn't get as much deduction for putting the money in, and they got most of their investment gains tax-free, but not all of them. Now, both of these investors are ready to start pulling money out of the portfolio. How do they do it? Well, the pre-tax investor, if he or she has $1 million in their portfolio, the pre-tax investor can draw about $49,000 a year out of that portfolio, adjusted for inflation. However, they're going to pay $191,000 on those withdrawals. So they're going to take out $49,000 a year for 20 years, at which point they'll reach the end of their portfolio, which also means they're done having birthday parties. They're going to take out $49,000 a year for 20 years, totaling $980,000. The tax on that $980,000 is going to be $191,600. So they put the money in a tax deductible way during their working years, where they got $128,000 in tax deductions for doing so, but they had to pay tax when that money came out, and the tax that was due on all those withdrawals was $191,000. So in the case of this investor, the net tax outflow was $62,655. In other words, they ended up, net of tax deductions, they ended up paying Uncle Sam $62,655. If there's one thing Uncle Sam's really good at, it's getting his cut, okay? Now, this person's colleague that has the 3 different types of accounts didn't get nearly the amount of deduction that the first investor did. The colleague only got $42,000 worth of deductions over the 30 years they were putting the money away. They've put away the same $1 million, but they're actually able to spend $52,000 a year, or $1,040,000 in retirement, because not all of their portfolio is taxed. If you look at the tax they paid in retirement, it's $81,719 as opposed to $191,600 if you compare the second to last line on both columns. The reason the tax paid in retirement is so low for the 3-account investor is because only 1/3 of his or her portfolio was built up in a pre-tax manner, so they only have to pay tax on 1/3 of their portfolio as the money comes out. See, the net tax outflow was $39,000 as opposed to $62,655. Let's put it a different way. If you're someone who has multiple accounts with different tax statuses, maybe a pre-tax account, a Roth account, and a taxable account, you want to spend the taxable money first, and that's what this person did. Starting at age 67, they started spending $52,000 a year out of their individual account, not their traditional IRA and not their Roth. They spent $52,000 a year until age 72, when the IRS began making them take required minimum distributions from their IRA. At age 74, the taxable account had been depleted, so at that point in time, they shifted and started taking all their distributions from their pre-tax IRA and paying the tax at the ordinary income rates. From 74 to 81, that's what they did, but starting at 81, now they have to dip into the Roth. The great thing about the Roth is that withdrawals from a Roth IRA are not taxable. And if you spend that money last, you give it the longest possible time to grow. And now this 81-year-old has a $750,000 portfolio that they don't have to cut Uncle Sam in on a penny. That is a very powerful thing. So the logical order of withdrawals: start with taxable accounts, then go to pre-tax accounts like 401ks, traditional IRAs, simples, and SEPs, and spend the Roth money last. Let that pile of tax-free money grow as long as you can. I'm going to share just a quick story with you. It came up this week and I thought would work well in this presentation. I had a client call me this week who wanted to buy a new 4-wheel drive vehicle. It was like a Tahoe or a Suburban, like something like that. And they called me up and they said, "Hey, Ted, send me $75,000 out of my traditional IRA." I said, "Why do you need all that money?" And he said, "Well, we're buying this new vehicle and that's how much it cost." And I jumped on Google, and sure enough, he was right. And I got to thinking about it, and I said, well, if I send you $75,000, that's actually going to be $100,000 withdrawal out of your portfolio, because it was coming out of an IRA that they had to pay both federal and state tax on. And I said, why don't we instead of taking a big chunk out of the portfolio and paying the big ugly tax bill, why don't we instead borrow the money, which he was able to get for 2.9%, as is on the screen. This is an actual case study. He was able to get it 2.9% for 48 months. And now, instead of paying tax on 75 grand all this year, he's able to stretch it out. He's able to spread the tax out over the 4 years that he has to make the payments on the vehicle. Now, if the day ever comes where for some reason he needs to pay off the vehicle, he certainly can. He has the cash to do so. But when you're in retirement, it's not so much a matter of saving yourself interest or staying out of debt. In a lot of cases, it's more of a matter of managing cash flow. And if you look at the interest rate on the loan of 2.9%, and you think back to what the stock market did this year at 16.5% return, the investor's a heck of a lot happier having their money in the stock market capturing that 16.5% return, as opposed to pulling it out, paying the big tax bill to avoid a 2.9% interest rate. You can borrow money really cheap at this point in time, and I'm a big believer that investors need to take advantage of that. We're getting close to the end here. The next module, it has to do with Social Security. I know I'm running short on time, so I'm going to go quickly. I'll dispense with one of my favorite Social Security jokes. And I'm just going to hit some of the highlights on each one of these slides. So Social Security averages your highest 35 earning years. You have to work at least 10 years or 40 quarters. They don't have to be consecutive in order to qualify for Social Security or retirement benefits. For those of us still working, we pay Social Security tax up to the first $137,700 we make. We pay 6.2 plus 1.45 Social Security and Medicare tax on the first 137.7. Our employer pays the other half. If you're lucky enough to be self-employed like me, you get to pay both halves because you're the employer and the employee. The full retirement age for Social Security varies depending on what year you were born. If you were born from 1955 to 1959, it's the age of 66 and then increases in two-month increments depending on what year between that range you were born. Your full retirement benefits for Social Security are what I kind of refer to as the baseline. If you decide to take benefits at 66 or 67, depending on what year you were born, you will get what the Social Security Administration calls your full retirement benefits, what you're entitled to given your 35 highest earning years. You can take it a little earlier if you want, but you're only going to get 70 to 75% of what you'd otherwise be entitled to. If you delay taking Social Security benefits till after your full retirement age, you get an 8% increase in benefit for every year that you wait between 66 and 70. It doesn't get any better than the age 70 benefit. So the question is, how do we optimize this? How do we squeeze every last dollar we can out of the Social Security Administration? I'm sorry, let me rephrase that. How do we get back any dollar we possibly could that we paid into the Social Security program? How do we get it back out? Well, there's a couple of strategies particularly available to married couples. In this case, we've got a husband that was born in 1960, wife the same age. Husband makes $100,000 a year, wife makes 40. If they both take it at age 62, their benefits are going to be $1,770. I'm sorry, the husband's benefits going to be $1,771 a month. Wife's benefits going to be $1,038. If they wait until their full retirement age, then the husband's benefits will be $2,530 a month. Wife's will be $1,484. And if they wait till 70, husband's benefits will be $3,137. Wife's benefits will be $1,840 a month. Something is interesting to point out, especially in this case study. Social Security is the most profound for low wage earners. In other words, Social Security benefits replace more of a low wage earner's income than a high wage earner's income. Look at what these two make. He makes 100 grand, she makes 40. it would stand to reason that her Social Security benefits should be 40% of what his are. Not true. Look at the scenario in the middle where they both claim that 67, he's getting 2530, she's getting 1484 a month, significantly more than 40% of his benefit, but it's because the higher your income gets, the less of your income Social Security is designed to replace. Okay. In this case, the best thing for both of them to do is wait till age 70. Now, let's say it's the same couple, but he makes considerably more and she makes considerably less. He makes 250 grand a year, she makes 25. Well, the optimal thing to do in this scenario is have the husband take his benefits at 70 and the wife take hers at 67. Why? Because we expect her to live longer and his benefit is higher. With that in mind, we want his benefit to be as high as it can possibly be, because she is going to inherit it for what will be the last 5 years of her life, and we want her to have that nice big benefit. That's what's going to allow them to capture the most from the Social Security program. Okay, same thing if there's a big age disparity. Okay, same situation here. Husband's 10 years older than the wife, she's going to get his big benefit for a lot of years, so we want that benefit to be as big as it can possibly be. Okay. Some people do. There is a defense. There is a defense to claiming Social Security early at that age of 62. If you don't expect to live that long, that's definitely the way to go. There is a break even. If you're looking at taking Social Security benefits at 62 as opposed to age 70, if you live older than 79, that was a bad move for you. If you take Social Security benefits at 62 as opposed to 66, if you live longer than age 75, that was a bad move for you. Let's talk about the elephant in the room. Will Social Security be there will Social Security even be there when we're claiming our benefits? Well, the Social Security Trust Fund publishes a report every year, and every year it says the same thing. We're good till 2034, and once 2035 comes around, we're only going to be able to meet about 3/4 of what we have of our obligations, basically. That's what the Social Security Trust Fund report says. We're good till 2034, but 2035, we're only projected to be able to meet 3/4 of our obligations. What might they do to fix that? Well, they may increase the full retirement age, change the tax cap, maybe tax on a higher level as opposed to just the 137 that it is this year, increase the amount of Social Security tax, or do means testing. Means testing would be you would have to prove a financial need in order to get Social Security. Good luck with that. I didn't have to prove a need to pay it in. Why should I have to prove a need to get it? Couple comments on required minimum distributions. The age on that went from 70 to 72, and they are not required this year due to the CARES Act. That's part of the 2020 stimulus package. If you're someone who's looking at taking required minimum distributions and you're charitably inclined, I would encourage you to look at what's called the qualified charitable distribution. I can share with you a couple of points on that. I would also encourage you to look at a Roth conversion strategy wherein less of your money is subject to required minimum distributions, but it does generate some tax. For the right investor at the right point in their life, it makes a lot of sense. Okay. It is 7:59. With that, I'm going to put the key takeaways up on the screen. If there's anything I'd like you to take away from this presentation, it's that retirement means something different to everybody. Ask yourself what it's going to mean to you. If you are a practice owner, there's a lot of models to transition ownership. What I always say is that if you're real smart and your buyer's real smart and you both want the same thing, you'll find a way to make it work. You need to make sure your portfolio is constructed to support your spending needs and take those withdrawals in logical order. Be sure to optimize your Social Security claiming strategies. Take advantage of qualified charitable distributions and Roth conversions when they're available. And when in doubt, call Ted. So with that, I didn't get any questions along the way, but I'd happily take some questions now. I can't thank everybody enough for spending their evening with me. Thank you so much.